Interest rates in the United States play a critical role in shaping the economy, influencing everything from personal finance decisions to the overall health of the stock market. In simple terms, an interest rate is the cost of borrowing money, and it's set by a combination of factors, including the Federal Reserve's monetary policies and broader economic conditions. When the Federal Reserve raises or lowers its benchmark interest rate, it directly affects how much consumers and businesses pay to borrow money or how much they earn on their savings. Currently, as of September 2024, the U.S. interest rates have been cut by 50 basis points, bringing them to a range of 4.75% to 5.0%. This move marks a significant shift from the high interest rate environment of the past few years. After the global pandemic, inflation soared to levels not seen in decades, and to combat this, the Federal Reserve raised interest rates aggressively. By doing so, they aimed to slow down borrowing and spending, which in turn would help bring inflation down. These rate hikes worked to some extent, but they also brought new challenges, such as slower economic growth and increased pressure on the job market. So, why did the Fed decide to cut rates now? Well, recent data suggests that inflation is finally cooling down. With inflation no longer the major threat it once was, the Fed is focusing on promoting growth and ensuring that the labor market remains strong. However, the U.S. economy still faces some risks, such as the potential for rising unemployment and a slowing housing market. The Federal Reserve is trying to strike a delicate balance between encouraging growth and keeping inflation under control. For the average consumer, this interest rate cut can have a variety of effects. On one hand, lower interest rates make it cheaper to borrow money. So, if you're in the market for a mortgage, a car loan, or even using credit cards, you might find that the cost of borrowing is lower than it was a few months ago. This can be especially beneficial for people looking to make big purchases or refinance their existing loans. On the other hand, savers may see the interest they earn on savings accounts and certificates of deposit CDs decrease as rates come down. For businesses, lower interest rates can provide a much-needed boost. Companies often rely on loans to fund new projects, invest in equipment, or expand their operations. When interest rates are lower, the cost of borrowing decreases, making it easier for businesses to invest in growth. This, in turn, can lead to job creation and overall economic expansion. However, there's also a flip side to this. If businesses become too reliant on cheap credit, they may overextend themselves, leading to financial instability down the road.
The stock market has reacted to this rate cut with a mix of excitement and caution. Historically, lower interest rates tend to boost stock prices, as they make borrowing cheaper for companies and increase consumer spending. After the rate cut, major indices like the S&P 500 and Nasdaq saw gains. However, investors are also aware that the Fed's decision signals a recognition of potential economic risks. If the economy weakens further, we could see more rate cuts, but that could also indicate deeper underlying issues with economic growth. Looking ahead, it's likely that the Federal Reserve will continue to monitor inflation and economic growth closely. If inflation remains under control and growth picks up, we could see interest rates remain at lower levels for an extended period. However, if inflation begins to rise again, the Fed may have to reverse course and raise rates to prevent the economy from overheating. For you, whether you're a consumer or a business owner, it's important to stay informed and be strategic about your financial decisions. If you're looking to take out a loan, now might be a good time to lock in a lower interest rate. On the other hand, if you're saving for the future, it might be worth exploring alternative investment options that can provide better returns in a low-rate environment. In conclusion, interest rates are a powerful tool used by the Federal Reserve to manage the U.S. economy. The recent rate cut reflects a shifting economic landscape, with the Fed focusing on promoting growth while keeping inflation in check. For individuals and businesses alike, understanding how these changes affect your financial situation is key to making informed decisions in today's economic environment. Stay tuned to InCoding US for more updates on how financial trends like this impact your everyday life.